Assalamu alaikum friends. How are you all doing? Are you excited for the last AFM 14 days revision crash course lecture? This is the last video on your revision series of AFM. The topic is reconstructions and reorganization. The smallest topic in your AFM syllabus, but which is often the most challenging topic that students often find. The reason is because this is a very dry area. It's boring to learn as well as to teach. Trust me. But don't worry, I'll make this a very interesting topic and you will love it. Make sure you watch this till the end since this is the last, and maybe at the end I will be giving you some valuable advice, tips for your AFM exam. So let's start with past exam history. What is financial distress? Assessing the risk of corporate failure. See, corporate failure, the failure and reconstruction, they are very much linked together. That's why we are studying this corporate failure. Because if the company is doing good, there is no reason to restructure or go for a reorganization. Rarely they do. It is mostly when your companies fail that we have to work our way out, restructure, right? Other predictors of corporate failure: financial reconstruction, business reorganization. So, in your past exam history, this topic is also asked in all. If you see, it has been asked in all the years except March 2020. All the years it has been asked. So you can see ratios and performance. You have to do some ratios. You have to be prepared for it. It has been asked once. Corporate reconstruction, unbundling strategies, impact on the statement of financial position, impact on earnings, impact on cost of capital has been asked. You see your cost of capital, that is your WACC. We studied in investment appraisal. It came for acquisition, merger, and now it's coming for reconstruction also. You can never forget that, okay? So let's start here. First, before going to reconstruction and reorganization methods or what could be the impact, you have to understand the term called financial distress. What is financial distress and what are the causes of it? We all know what is financial distress, right? When you're financially not okay, you're not solvent, right? But what are the causes? Five main causes. Number one, when your revenue, you're not getting enough revenue. Cost, you're not able to control your cost is going up. Third, your asset, you're not being able to manage it well. Four, failing in managing a liability. And capital management. These are the five areas which can cause you financial distress. Okay. Now, these problems will rarely arise in isolation. In reality, it does not happen. If it affects one area, automatically the effect will be shown in the other areas also. It's like a wheel. They are connected to each other. You cannot treat each one in isolation. You cannot say just because only revenue failed, I will only take revenue and I don't have to see about. No. If you are unable to control your cost, a day will come, you will reach to a point where your revenue, you will not be able to get much revenue also because your cost was poor. You are not being able to manage your cost properly. This can affect your liability management. Why? Because to overcome that cost or because you are not getting enough revenue, you will now go for loan. So your liability management is also failing there. And because of that, asset management, capital management, everything comes one by one. Okay. Now, assessing the risk of corporate failure. What is the meaning of corporate failure? Corporate failure means when a company cannot achieve the satisfactory return on capital. And this is over a longer term. Okay. No one will go for reconstruction only for a short period of failure. No, 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 no. Corporate failure occurs over a longer term. When it is affecting a long term, that's when we are focusing on reconstruction, reorganization. Because this can lead to insolvency. Okay. And reasons are generally non-financial and include an inability to adapt to changes in the environment. Corporate failure means you are not being able to adjust with the environment. Okay. So, how can you assess the risk of corporate failure? How can you say a company is failing? Just by seeing the company or the statement of financial position? No. You have to analyze it through accounting ratios, through trends. You have to see the trend. Okay. So, For this topic, for this AFM part, reconstruction reorganization, you have to know accounting ratios. Make sure you know all the formulas. You have to by heart it if you don't know. Okay, it is not there in your formula sheet. You might not be asked specifically to do this ratio, but you have to do ratios because otherwise you cannot analyze the performance. It's not always ratios are asked, but if you have been asked to analyze the performance of a company, you have to use ratios. And to know ratios, you have to know the formula, right? But let me make this a little bit easier for you. Why? Ratios are vast. What ratios will you will take? Divide your ratios into 4 areas: profitability, liquidity, gearing, and stock market ratio. Okay, under profitability, we have net profit margin, gross profit margin, return on capital employed, things like that, which talks about profit. Liquidity is your working capital ratio, asset to ratio. Gearing, it's about your debt equity. And stock market ratios are like your earnings per share, PE ratio, ratios like that. Okay, now other predictors of corporate failure. You can analyze your free cash flow. You can check the information in the company report. Information from the press will tell you. Information regarding an external issue. A going concern evaluation might help you. Okay, and such information may be provided in a form of notes in a case study. See, in your exam, they might tell you, give you this, right? In your exhibits. Remember, such models only show a snapshot. That means they are only best for the short-term predictors. So you have to analyze them further. Okay. Now, we are moving on to the main topic. This is the topic, right? Financial reconstruction. Remember, financial reconstructions are not always taken by companies which are having financial distress or insolvent. No, no, no. It can be taken by healthy companies also. Okay. So they can be taken by both companies which are healthy as well as in financial distress. Okay. But the objectives of the two to reconstruct is different. That is the area where difference comes. If it's for a solvent company, the objectives of reconstructions are this: to improve the capital mix. Let's say you want to improve. You are having two debt. You might want to replace one out of two debt. One debt you might want to replace it with equity, so that your gearing ratio goes down. That also could be done. Second, improving the timing of availability of finance. Let's say you're having too many of debts and you have to pay interest, right? So you're turning one debt to equity, like that. But you're solvent, you're still solvent, but you want to improve. Options available, these are the options available. Convert debt to equity. You can convert equity. See, this is how you do financial reconstruction, okay? Either you convert debt to equity or equity to debt, or one equity to another equity, or one debt to another debt. For example, loan to bond or things like that. Now, for failing companies, if it's a failing company, this is the most like needed for us also, because mostly what I've seen in AFM, they give you a failing company. I have not seen the giving you a solvent company, but they can give you anything. If it's a failing company, objective is to attract fresh capital. Why? Failing companies are the one which cannot attract capital. For them, it's more difficult. Now they want to attract fresh capital through restructuring. Second, persuading its creditors to accept some security as a settlement for debt. Even if they cannot pay you the entire amount, at least accept some security so that they do not have to wind up. So that they can prevent the company from going into liquidation. These are the options available for them: a company voluntary arrangement, an administration order. Okay, these are the two. Here, this is a general procedure in devising a reconstruction scheme. Make sure you go through this, because this is important for your exam purpose also. You do not have to write all the steps, no, but at least you have to know the procedure, how a reconstruction is done. First, if there is any asset, fictitious asset, write it off. Write off fictitious assets and the debit balance on profit and loss account. Okay, then revalue the asset so that you get the current value. Second, check, do you need any further finance after this? And second question, how much do you need and in what form? Form matters a lot. And from whom it is obtainable. Do you want loan? Do you want shares? Do you want it from existing shareholder or from the bank? Third, in a reasonable manner, okay, in spreading, okay, determine a reasonable method in spreading the write-off. That means the capital loss. You have to divide this capital loss between shareholders and creditors. 4. Agree the scheme with the various parties. See, whenever you go through some scheme, this has to be agreed with the various parties. The creditors have to accept it, shareholders have to accept it, venture capital have to accept it if there is one. Okay. Now, the design of a reconstruction scheme, okay, needs to take into account the interest and the impact upon this. Whenever reconstruction, often this has been asked in a report, right? If you have been asked to make a report, after calculations are done, they will often ask you this: what are the impact on the ordinary shareholder? What are the impact on the preference shareholder? What are the impact on the debt holders? So don't forget this three. At least these three parties don't forget: ordinary, preference, venture capital if they have, and creditors. Okay, you have to write on it. Coming to business reorganization. Reconstruction is over now. Business reorganization. There are two different terms. Business reorganization. Okay, unbundling. What is unbundling? See, understand. Acquisition and merger was two company becoming one. You are joining there. Business reorganization, you are separating. One company becoming two or three or four, whatever. But it is the opposite of merger. Understand that. Okay. Here you are unbundling. In acquisition merger, you are bundling everything, joining together and becoming one. Here, one is becoming into many different parts. Unbundling. You unbundle them. Okay. So unbundling means now you are selling off your non-core business. Why do you do that? Why do you want to sell off? It's like you're selling your business. Not entire business, but at least part of the business. But why do you want to do that? You might want to get more fund. You might want to reduce your gearing. You might think management can concentrate better on the core business. Okay, whatever it is, key objective is to increase shareholder wealth. Understand this. These are the forms of unbundling, and these are the things you have to know. Spin-off or demerger, management buyout, sell-off, liquidation. Demerger is the opposite of merger. One company becoming two. Management buyout. Management buyout means you are selling your business to the manager who were there in your business. Existing manager. They are taking it over and then they're running it. Sell-off. You're selling it. Part of a branch or a division. Liquidation. You're liquidating. Okay. Each of these forms of unbundling are different from each other. You have to know it. Okay. For example, Australian airline Qantas split its international and domestic operations via demerger. Earlier it was one. Now it's two. International is separate, domestic operation is separate. Management buyout. This is a very, very likely topic to be asked by the examiner. I think they like it so much. Okay, there are variations here. Management buyout, leverage buyout, employee buyout. Okay, what is the meaning of it? Management buyout means the word management says existing management. Employee buyout, your employees. Leverage buyout. What is leverage buyout? You can Google it and check it out, right? Now, but these are the three variations. Mostly it is a management buyout. Okay. Considerations before management buyout. See, these are the things you have to consider. Often this has to be answered when it is asked. This could be asked as a theory question. Okay. For writing, discussion question. Okay. Don't write it in a form of question in your answer in AFM. Please avoid it. Never write a sentence by a question. You always have to write in a form of a sentence. Explain it. Okay. So do the current owner wishes to sell it? Second, what is the potential of the business? Third, loss of head office support. What could be the impact if you lose the head office support? Quality of the management team. Are they of quality that they can run your business well if you sell them to the manager? These things you have to consider before you actually sell it to the management. Okay. The price, obviously. Is it too high? Is it too low that you are getting from the manager? All these things. Reasons for the buyout. Why do shareholder wants to go for a buyout? Number one, if the parent company wishes to sell. Okay. Second, parent might want cash. Subsidiary might not fit with the parent's strategy, so they thought it's better to sell. Subsidiary might be too small for the parent. Parents feel that they should not give too much of time to it because they're too small for it, so they sell. Or cheaper to sell a loss-making subsidiary to the manager rather than going to liquidation. They feel better to sell it to manager and get some money rather than liquidating it entirely. Private shareholders wish to sell out. Yes. Liquidity and tax factor. Family succession problem. There might be issues with family succession. There might be no one as a successor, so you sell it to the manager, right? These are some reasons. You can give 3 or 4 reasons depending on the number of the marks if they ask. Now, how do you finance? See, this is also a topic which is asked, okay? Financing one. In an MBO, see, there are 2 terms that you have to know before I go on because I think this is the last slide. Before I finish it, there are 2 terms that you have to know. One is known as management buyout, MBO. The other one is known as management buy-in, MBI. And these 2 terms are different. How? MBO means you are selling your company to the existing manager who have worked in your business, okay, or who are currently working as a manager in your business. Management buy-in, MBI, means you are selling your business to managers outside your company. You understanding? That's the difference. This is often asked in the exam. What is the difference between MBO and MBI? Why would they would go for MBO? No, why not MBI? Things like that. That's why I made it very clear for you. Okay. How now? Back to the slide. How do you finance MBO? Because see, in an MBO, because managers are your employees only, right? So they will lack that financial resource because they are acquiring it from you. So to fund that acquisition, they might lack the financial resources. Okay. So this is how they can go for it. They can approach a venture capital. What is a venture capital? Venture capitals are individuals, okay, are companies who invest on growing companies who have a potential to grow, and they take a share for it. They usually exit from 5 to 7 years. They exit the company by taking their fund, but they have huge amount of money to invest. They are wealthy individuals, right? Wealthy companies. So venture capital, they can approach venture capital, they can go to banks, take a loan, pension fund, an insurance company, merchant banks. All these things you don't have to know what is the difference between clearing bank, merchant bank. Just know bank, okay? That's enough. Specialist such as 3i and equity capital for industry, anything, okay? Usually for your exam, just focus on banks and venture capital. These 2 are enough. You don't have to go for other areas, okay? But know that in reality there are other things also. That's why I've included it here. Or government agencies and local authorities. So with this, what's next? It's the end, and my job is over for AFM. I have all the lectures. I have all the AFM revision series is over. You can go and download it. What you need to do is when you go to my channel Sabi Akhtar, go to my about section, go down and you will get ACCA material. If you click on ACCA material, you will get all the books, P level books. I think except APM, advanced taxation, other books are available there. AFM, SBR, SBL and AAA. Both revision book, revision kit and the textbook of Kaplan, the latest till June 2023. The latest Kaplan books are available there. You can download it. Okay. And if you want to get the slides, the lecture, as well as this AFM revision series. Again, it's in the same place, about section. Go down, go to specific. If it's, for example, you want to download AFM lecture, the slides, you have to click AFM lecture. If you want to download my SBL lecture, you have to click SBL lecture. It is by the name. And for AFM revision crash course, I have named it AFM revision crash course. Go there and download all the 14 slides, 14 giga slide. Yeah, so that's it. And I think that shall make your work very easy, because now you have my slides which is accessible to you, as well as my videos with the explanation. What else? The last tip before I exit, I want to tell us, my job is over. Now it's your job. Do as many questions on AFM. Okay, risk management, acquisition and merger, investment appraisal, this reconstruction, reorganization, and your section A, which is theory. Okay, do all the questions, all the areas you have to touch when you're doing a question. Okay, time yourself 3 or 15 minutes, work on the professional skills as well. Now you have professional skills. Okay, write it in a form of report if it is asked. Make sure you know the format of report, things like that. Make sure you are writing it with the correct tone. Okay, the way you write, the tone of matters a lot this time, especially this time, because you have 20 professional marks this time. Okay, and best of luck for your AFM, and please do attempt all the questions. Don't leave any questions unattempted, even if you don't know. Just do anything whatever you know, but don't leave anything empty. Okay, the examiner cannot give you marks if you have not written anything. At least if you have written something, you might get something out of it. Okay, and do it on a CB platform, not manually. Not writing will not help you. Okay, make sure you know all the formulas in Excel, the shortcuts. Before the exam, you have to know all those things. You don't have to discover all this on the day of the exam. No, you have to be a pro on the CBE before exam. If you are not, you are struggling. How will you know it? It's very simple. If you are able to finish the paper in 3 or 15 minutes with confidence, okay, if you are able to manage all the questions, the calculations, and the theory part in 3 or 15 minutes, that means hats off, you have done a good job. You will not struggle in the real exam. Trust me. Even if you do, you will still be like on the track. But if you're not able to finish that paper in 3 or 15 minutes, all the three questions in 3 or 15 minutes, that means you need more practice. Okay, so these are the tips that I want to give. And past paper, yes, definitely past paper is the thing you have to do. If you are not able to finish the entire revision kit, don't worry, just pick 3 or 4 past papers, do it, but do it well, do it properly, rather than doing 10 past papers or 30-40 revision kit questions poorly. Do 3 to 4 papers well. That's enough, okay, to give you that much confidence. And also make sure that each day your speed is increasing. Okay, and what else? I think that's it. If anything else you require, you can contact me, you can email me, and I shall get back to you. Yeah, so that's it, and best of luck. Take care. God bless you.